Hey everyone, welcome. Today we're going to talk about something that might just be the most important structure you can build in your trading career, the architecture of survival. We're going to tackle position sizing, but not with hype or crazy predictions. Instead, we're focusing on a calm, practical process that's all about keeping you in the game. Let's get into it. So here's what we've got on deck. We'll kick things off with the #1 mistake that ends trading accounts. Then we'll flip the whole question you should be asking yourself. After that, we'll get into the simple mechanics of the sizing seesaw. I'll give you a 60-second checklist to use before any trade. We'll talk about a sneaky risk you have to watch out for, and we'll wrap it all up with the ultimate goal, just surviving long enough to learn.
All right, first things first, let's talk about the account killer. It's a surprisingly common trap, but it is absolutely fatal for traders who don't see it coming.
And here it is. This is the core truth, isn't it? It's almost never a dozen small losses that wipe someone out. It's that one trade, the one where they got overconfident, went way too big, and let their emotions take the wheel instead of their plan. That's the one that does the catastrophic damage.
Now, before we get into the nitty-gritty, you know the drill. This is all for educational purposes. It's not financial advice. Digital assets are super risky, so please, always do your own research.
Okay, let's get to the real heart of this. This section is all about a simple but incredibly powerful mindset shift. It's what separates the amateurs from the pros, and it all comes down to flipping the question you ask yourself before you even think about placing a trade. You see, beginners are obsessed with being right. They're constantly asking, how can I find the perfect entry? But professionals, they're obsessed with what happens when they're wrong. They plan for it from the very beginning. And that single change in perspective, well, that's the foundation of real risk management. So how do you plan for being wrong? Well, it all starts with this one concept, invalidation. This is your line in the sand. It's the point, whether it's a price, a market condition, whatever. Well, you just have to admit, okay, my thesis was incorrect, and you get out. If you don't have this defined before you enter, you don't have a trade. You just have a hope.
So once you know where you're wrong, the very next question is, how much are you okay with losing if you get there? This is your risk per trade. And notice the order here. This is so important. You choose your maximum potential loss before you even think about how big your position is going to be. This is a total game changer.
And this slide just lays it all out, doesn't it? The difference is night and day. The beginner just picks a size that feels right and then lets fear and greed drive the bus. The pro? They decide on a max loss they can stomach, and then they do the math to figure out a position size that fits that predefined risk. It's all about process over passion.
Okay, let's talk about what I like to call the sizing seesaw. This is the simple, totally unbreakable relationship between how much room your trade needs to breathe and how big your position can actually be. And the best part, the math is incredibly simple. So let's say your plan needs a lot of space. You need to put your invalidation point pretty far away from where you get in.
Well, if you want to keep your risk the same, your position size has to be smaller. There's just no way around it. It's a mathematical certainty.
Now let's flip that around. What if your trade idea is super precise? You've got a really tight invalidation point that's right near your entry.
Well, in that case, you could actually take on a much larger position size for the exact same dollar risk. You just can't cheat this relationship. You can have a wide stop or you can have a big size, but for a small risk, you can't have both. You have to pick your trade-off. All right, theory is great, but how do we make this practical? Well, here's a super simple framework you can run through in like 60 seconds before you even think about clicking a button, just to make sure you've covered all your bases.
Let's just walk through it real quick. #1, define your invalidation. Ask yourself, where am I wrong? 2, choose your max risk. How much am I willing to lose? 3, size your position based on that distance to your invalidation. 4, check the execution conditions. Can the market even handle this trade right now? 5, plan your exit. How are you going to take profits? And finally, step 6, and this is probably the most important one. If any of this stuff is unclear, you do nothing. You are never ever forced to take a trade.
Now, for a really crucial step that gets forgotten all the time, but it can absolutely wreck a perfect plan, execution risk. This is where your nice, clean strategy meets the messy reality of the market.
You can see these warning signs everywhere. On any exchange, look for wide spreads. That's that big gap between the buy and sell price. Or maybe the order book looks really thin, not a lot of orders there. If you're on a DEX, watch out for high price impact or a low minimum received amount.
These are all just signs that the market is thin, and trying to push a big order through is going to cause a ton of slippage. The right move isn't to power through it. It's to reduce your size or just walk away and wait for a better time.
And all of this brings us to the ultimate goal of this entire process. It's not about hitting home runs. It's not about getting rich tomorrow. It's about something much more fundamental. It's about survival.
So let's just nail down the key takeaways, right? 1. Position sizing is your main lever for controlling risk. 2. Your invalidation point is your objective way to admit you're wrong. 3. Your risk per trade is your preset budget for being wrong. And 4. The market conditions tell you if your plan is even possible to execute right now. You master these and you give yourself the most valuable thing there is, time to learn.
And just a quick note, especially for our viewers in the United States or other places with strict rules, please remember this is all for educational purposes. Always follow your local regulations and do your own independent homework.
So I'll just leave you with this one question to chew on. If this disciplined process of managing your losses is the real key to survival, then is that shiny metric everyone chases, a high win rate, really what matters most? Or could it actually be a trap? Something to think about. Thanks for tuning in.